I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that help boost your trading potential. Coming up, markets are navigating AI volatility, tariff uncertainty, sector rotation. Investors also positioning themselves ahead of NVIDIA earnings and fresh economic data. It's a lot. That's what we're here for. Meantime, our trading debaters, they're standing by to break down the bull and bear cases on TJX Companies. It's off-price resilience versus valuation reality. Plus, actionable option strategies to play both sides. We're also going to talk about what investors should watch when Monster Beverage reports earnings later this week. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour into the trading day. We had some downside action yesterday on those concerns about AI disruption and tariffs. Got a little bit of green on the screen today with the S&P 500. It is modest. We'll see if it holds through the rest of the session. Want to jump into the heat map and see what's happening here. It's a bit of a checkered map. You got some strength in Apple. NVIDIA sort of hanging back. And now AMD is very small here, but it is up 7%. Home Depot somewhere else on the board up 7%. Home Depot beating the street's estimates for the latest quarter. And AMD actually has a multi-year deal with Meta. It's going to supply it with 6 gigawatts of their own graphics processing units for their data centers. So that's got the stock on the move. But let's jump into our stock of the hour. It is TJX Companies. Why did we pick it for the bear bull debate? Well, it's got winners, it's got Marshalls, it's got TJX Companies under its banner. Which of us have not shopped the off-price retail? You can admit it. I've done it too. Not wearing any winners today, but actually was yesterday with my pair of pants. And we just want to know, can this kind of price action continue? Or is it set to move in a different way? That's the whole point of the bear bull debate. Let's get over to the desk here and welcome our debaters. We got Jason Natick and Hiran Amin from our direct investing team. Gentlemen, getting ready for another show. And we got a special treat today. We have our Wealth Contact Center quarterly top performers with us as a live studio audience. Thanks for joining us. We're going to get you involved in the show at some point. I don't know if we'll get you involved in the bear bull debate, but we might get you to cheer at some point. Before we get going on everything we've got for you today, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now let's get back to the stock of the hour. TJX Companies, we'll get some time on the clock. You each get your 2.5 minutes to make your cases. Then we're going to have some time to counter. As always, we draw from the hat, and this week it is Hiran who's got the bull case. Why don't you kick things off for us?
Yeah, great. I'm glad that I got the counter as well. I was flying blind last week. So let's start. Let me paint the picture for everyone when we're talking about TJX. The economy is uncertain, inflation stubborn, the consumer stressed, and somewhere out there, a treasure hunter is elbow wide in TJX discount racks, pulling a $200 cashmere for the grand price of $29.99, and they have never been happier. Now, this is the bullish investment thesis, but if that's not enough, then TJX Company isn't just a retailer, it's a business model that's built to win in any economy. Let me break it down with 2 points that I want to make. First is the off-price business model that is a structural moat for him. So TJX's entire model is built around buying other people's problems. So we're talking about manufacturer overruns, canceled orders, excess inventory, and turning them into consumers' delight. This means they always buy at a discount to retail, structurally protecting their margins, regardless of the economic environment. It's genuinely hard to replicate at scale, and TJX has been doing it for, guess what, 50 years. When you also think about how they're doing this, well, they have vendor relationships and they source from over 100 countries with over 21,000 different suppliers, and that's how they have incredible purchasing power. The second thing is the treasure hunt experience that I wanted to chat about. So here, this is what draws shoppers and their wallets, as wallets tighten, to their stores. So unlike a standard retailer where you have the same shelves products every week, TJX's inventory is always rotating, so it gives you that experience, giving shoppers the angst to come back, or the willingness to come back and get something new and feel something different. Now, management themselves have described the in-store shopping as a key advantage, believing the treasure hunt experience will continue to resonate with customers as a durable differentiator against e-commerce, which is seen as a threat. And that's been seen on the top line. They delivered 5% comparable sales growth, and that was driven entirely by customer transaction growth across every single division. Let's go into the charts and talk about how the price action is shaping up, though. So we've seen a long and strong bullish run that it started since April. We made this strong sort of pattern. One of the first patterns I wanted to show everyone is this ascending triangle. It's seen as a bullish sort of reversal. So we see it kind of hit the tops of this resistance level, but once it was able to break through, it completed a move and went on to make another significant move. Now, in between that time and into the end of 2025 and coming to the start of this year, it has formed sort of I would say, sort of taken a breather on its longer run, where it has formed an inverse head and shoulders, which is a mark for another move up at kind of the 170, 175 level.
The bull is bullish. What does the bear have to say?
Well, the bear, when we did our proverbial coin toss here, it caused a little debate, not just in the studio, but at home, because my wife is an avid frequenter of these stores, and I think it can be a little bit of a positive and negative thing for TJX, is we've got lots of volume coming into the house, but there's always lots of returns going out, so the inventory is coming in and out of our house as fast as it is, as the stores are as well. But bottom line, strong operator, but they have premium valuation. We've talked about this with other companies, priced to perfection. This is a company that only has moderate growth expectations. They've got extreme margin sensitivity, and there's real downside risk if the consumer, either the spending softens or if it returns normal and higher end prices or higher end buyers are able to move up back to their kind of more luxury brands. All right, but let's move into a couple key points. One I really want to hit on is the margin pressures. TJX gross margins has recently been hovering around the 29-30%, but we've got significant kind of inroads making in there. We've got freight, wage inflation, shrink. There are actual structural headwinds to their model. In fact, TJX's general and admin expenses, we've seen them increasing 3 of the last 4 quarters, so that's not nothing. Even a 100 bip kind of a margin compression on a $50 billion annual revenue, that materially is going to be impacting their earnings. All right, so next is going to be slower comparable sales momentum. Recently, growth is cooled to mid-single digits when we're talking about that, well off of post-pandemic highs, so that's solid. But TJX trades at a premium, and some of their competitors are trading more. And when we're thinking about forward-looking 30x PE, that's a lot. If comps start to slow by 2 to 3%, that's really going to be stretching kind of the valuation narrative. And one thing I want to talk about here is inventory costs. Recently, we've seen big surges in the inventory costs. We're talking 12% in the last quarter, not offset by sales increases. We've only seen marginal increases of 5% there. All right, let's get ourselves in the chart. And it's certainly unquestionable the stock over the last 24 to 18 months has been on a bull run. So we're looking for opportunities to time things right when secondary trends are hitting. One thing, hey, we're talking earnings here. We've noticed out of 2 out of the last 4 earnings, we've seen significant downward multi-day sell-offs of greater than 10%. And in fact, the last 2 earnings periods themselves have shown over 3% on the day of earnings as well. So there's lots of uncertainty. The market's kind of on that razor's edge. But then if we go into kind of much shorter time frames, let's bring that up as I kind of adjust my studies here on the chart. What we've noticed is a significant resistance point around that 150, 160 zone. 4 times the stock has bounced its head off the upper end of the Keltner channel. That's twice the average true range, retreated back, and we're kind of approaching ourselves in this ascending continuation triangle.
All right, Jay was willing to concede that this is a company that has performed strong, but he has some concerns. Time to counter back and forth.
Yeah, let me start with the numbers, though, because he did present quite a few numbers, and I wanted to talk about the top line and sort of the bottom line. But let's just talk about, when you talked about gross margins, Jay, they've in fact expanded their gross margin by 70 basis points to about 30.5%. Now, this is by far and large the leader of the pack. When you think about the discount retailer space, their biggest competition is Ross Stores, maybe Burlington Coat Factory as well, but it would be probably Ross Stores. When you think about even the efficiency of a business, you look at return on efficiency, and that's at 58%. Return on invested capital sits at 21%. Ross Stores sits at 38% and 17%. So when you're talking about the top of the pack or there's any threat, there's no question that TJX is by far and a mile away ahead of Ross Stores.
Beauty is certainly in the eye of the beholder in this particular case. If we want to go down that efficiency road, TJX spent $1 billion, that's billion with a B, on inventory more in 2025 than they did in 2024. And if we're going to start to think about fast fashion, well, guess what? It's starting to kind of look at like a fast walk fashion in this particular case. They're at a 13, they're well above their 13-day median, which is days to inventory. We're looking at time for a product to get off their shelf. That was sitting at a median of 57 days. By the end of last year, we're almost 75 days. So that churn is not quite at levels that TJX needs to have to keep those margins tight, to keep their customers coming back.
Okay, so talk about cost. So if they did have, they had more expenses and they're paying more to acquire the inventory, it's also about the revenue. So for guidance, the company as management has come out and said they anticipate about $68.6 billion in revenue for this upcoming year, 6.3 billion in earnings. That's 9% year over year. Even if you just look at the 9%, that's about roughly on the revenue side, you're looking at about 6 billion compared to a 1 billion spend. That's good return on efficiency. The other thing that I will also mention, if a company is is growing at the scale that they are, they have anticipation to have a target of 7,000 stores. They sit at 5,191 currently, but they're also geographically diversified than any other player in the space. They're across their presence in Europe, Australia, obviously in Canada, we know them, HomeSense, Winners, Marshalls, of course, is the local ones over here, but also Spain. So they're expanding on all fronts over there. And then I think the other thing that you have to remember is when you grow your gross margins. So let me come back to that point because that's what the bottom line is. They had 30.85% gross margins. They have 12.5% on the operating margin. Again, better than the competition that they have there.
Do you know where they're not growing? We're talking, and they've actively stopped participating. It's that e-commerce route. So they in one business, in their home goods business, in 2023 they exited that market altogether. And this is when.
But you don't need e-commerce. This is the whole treasure experience.
Sure, you don't. But when you're thinking about the society's moving towards an ease, 16% of all transactions happen through online, and you remove your business from that's starting to raise a lot of questions. And I know Target and TJX aren't like for like comparisons, but Target has opportunities for their customers to have same-day shipping, to have curbside delivery. They've even got an opportunity to have kind of like in-house brands that can be cost-effective and controlled. The TJX.
I don't know. Check a Target stock price, and then we can talk.
Oh yeah, spirited. You know what? I forgot before we started to do a very important disclosure, so I'm going to do it in steps. Who around this desk actually has some Winners, Marshalls, HomeSense stuff in their house, part of their wardrobe? Don't be shy. Don't be shy. God, I was wearing a pair of pants yesterday when I was hosting the show that I bought from Winners, so I don't want them covered in salt. Yeah. How about our live studio audience? Shopped at Winners?
Shops there every day.
There you go.
So look at that. Okay, you're bullish. Sure.
So we know. Okay, so we've had a nice debate about it. We've got the important disclosure thing that I've got some Winners in my closet at home. Let's get into the platform and explain how we could trade this one for some option strategies. Let's start with the bull.
Yeah, absolutely, Greg. So let's talk about the bullish case if you wanted to play the upside on the trade. So looking at the charts first, I think sort of the big tailwinds that are coming into this earnings print. One is, they've just made all-time highs, especially now with more tariff chatter back on the table. They're still making all-time highs just as of yesterday. There's a bullish pattern that's emerging where they could make a measured move coming to the 170 level. So one of the trades you could potentially look at doing is a longer dated bull call spread trade. And I'm just going to bring this up on the charts. We'll just narrow it down here. So essentially what I'm looking to do is I'm looking to go out on a longer dated cycle. So we're going out to the January 27 cycle. And the reason I'm doing it is for a couple of reasons. One is I'm looking at the implied volatility percentile. It's fairly low compared to its historical level, which means being a buyer of options is going to be net positive in terms of the value that you're going to get out of it. Coming into this earnings print, the expected move is about $8.25. But they've had a strong run, so giving us a lot of time as well also hedges that time decay risk that you have when you're going with this trade. So what we're looking to do is look to buy just out of the money right now, which is sitting at the 160 call. We're going for the January cycle, and we're looking to sell a further out at the 180 strike call. And this is just to take some credit in to reduce the overall cost. That's a big thing you'll notice on the show. That's a repeated thing. We want to minimize the cost, which improves our break even, which improves our profitability. In this case, I'm spending about $7.75. This is as of the pricing as of close yesterday, which translates to $775 on a single contract. We're doing a 20 wide spread on this trade so far here.
So you're the bull. This is the way you set up your trade. What if Jay's argument prevails?
If it goes that way?
Yeah. What if it goes that way? What happens to your trade?
All right. Let's see the scenario. What could play out if it doesn't? Well, let's talk about if it goes in my favor first. We'll start there. So If you're talking about the max profit situation, is obviously we want an upside move, and we really want it to move past the 180 strike if it can do that. If it can do that, we're going to be, the total spread will be worth $20. We paid $7.75 for it. That means we're going to take a profit of $12.25. In other words, $1,225. If it doesn't go our way, the great thing about doing a net long or debit trade is you will only lose what you put into it. In this case, it is going to be the 775. And that means if we decide to hold it all the way until expiry and the stock is below 160, that's when we're going to be bust on the trade.
Very interesting stuff. Jay, a possible bear option strategy.
All right, this is a nice kind of contrast. Here and showing us how we can go bullish with a call spread. I'm going to take it the other side. We're going to generate some income. We're going to take a bearish play with you. This time we're going to use a bear call spread or a credit call spread. So here's an opportunity. We already mentioned it's been a predominantly bull market. So this is a time where we can minimize some risk by really controlling the amount of time that we're going to be selling. We're also looking to be kind of pretty cognizant of selling strike prices that have a really higher probability of expiring worthless and out of the money. So if we just jump to the chart, we can talk that through. So the strategy that we're talking about is selling 165 call out to March 20th. So we've got a couple weeks worth of time that we're selling in that case. As of when I drew the trade up, it had a 29 delta on that, meaning it's a 71% probability of expiring worthless and out of the money. So that's in our favor. And then also to limit the upside risk on the trade, we're going to go ahead and buy or potentially buy a 175 call. So that $10 wide spread is going to be what's limiting our loss to the upside if this goes up and away from us. So it's kind of defining that loss where a naked or an uncovered call would not have. So talking through this trade of kind of why we've got there, as I said, it's kind of around that 160 support level or I should say resistance level where the stock has bounced its head off it. We've had a couple red candles bouncing off the top of the Keltner channel. Also noting here the money flow index, I want to notice that we've reached up to the 80 level. We started to see and showing momentum and volume is starting to drop away. So it's giving us extra consideration that the 165 very well could expire worthless. And we're taking in a smaller credit in this particular case. When I drew it up, it was 165. So it's $165. Does any credit trade that you make with options is going to be your max gain is what you take in at the top of the trade. I know where the conversation is going to this from a risk reward perspective. So Huron does these nice reveals. I wanted to join the party here. Max gain is at 165. Loss is always going to be the width of the spread. So keeping on, we're selling 165, buying the 175, $10 width. So the loss is going to be captured at the width of your spread, $10 less the $1.65 or $8.35 is kind of what we're captured with. Smaller gain, but selling the low probability of being assigned. So that's kind of where that rationale comes from here.
All right, interesting stuff there for our audience to consider. Thanks for laying out the bear and the bull cases for TJX Companies. And just a reminder to our viewers that this debate was for educational purposes, does not reflect our personal opinions about the stock. Jason, before we move on, you're going to tell us more about the money flow index.
Yeah, I sprinkled it in there right at the end. I wanted to kind of really kind of keep my time, get the bear case involved with my trade a little bit there. But the money flow index is kind of an evolution of the RSI, or relative strength index. So you're taking price action momentum, but you're able to kind of factor in volume into that. So it kind of really makes a kind of an all-encompassing overview of kind of where things are going in price action and kind of participation in the market. So jumping into the chart, let's take a look here. It goes from 0 to 100. Those are the ranges. And when we're looking at on the chart, overbought at the default for money docs, which is the blue line at the top, is set to 80. Oversold is set to 20 at the bottom. So RSI is default set to 70-30. So you can see there's a bit of a difference there. We're looking for breakouts above and breakouts below, as well as those cross points. Where another key thing that we look for, this is very similar to RSI, is going to be a divergence from what the stock price is doing. So is the index flowing in the same direction, or is it happening diverging? Because that is where these types of indicators can really be helpful when we're looking for you can be viewed as leading indicators. Whereas when we think about moving averages, as we can see in kind of the center line of our Keltner at the top, those are typically viewed as lagging indicators. Okay, so we're looking to see when the stock is, or when the index is crossing above and trending up to find that direction, as well as trending down. Those are those things that we're looking for, the trends in stock prices, as well as these indicators, trying to tie it all together. It's typically used as a tool to confirm other signals that you're seeing in a chart, not used as a standalone trading implication, though.
Okay, interesting stuff. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see these two guys go head-to-head on, send us an email at td.activetraderlive@td.com. For more information about the ActuTrader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD ActuTrader Live website. You can try out the platform risk-free by opening a practice account. You click on the Try TD ActuTrader button. Then when you're ready to switch to a live account, simply export your workspace, start trading for real. Now it's time to find out what's on the radar for the rest of the trading week. What do you got your eyes on here?
Yeah, it's a busy week, Greg. I think probably at the forefront of a lot of investors will be the tariff situation. I mean, we heard stuff coming out of the weekend, the SCOTUS striking down. But I think the big questions are looming for a few things. One is the countries that have struck deals and have had struck better deals than the now blanket imposed, which is, it used to be 15 as of yesterday. Now it's, as of this morning, it's a 10%. What does it mean for them in any other country that has a higher deal? What does it mean if they get a lower deal? So I think there's going to be a little bit more jitter in the markets on that front. But apart from that, the other big thing that you'd also want to understand is the big catalyst this week, the showstopper, is NVIDIA's earnings. And it'll spotlight really the whole worldwide AI trade and how it's performing. Its guidance is going to be key to its moving, but it's also going to impact the wider stocks around its periphery. That's going to be of key at the end of the week. So that's one we'll look out for. On the macro front, it's a bit lighter, but the big numbers that we want to look at will be at the end of the week. It's going to be the producer price index. This will be for the January numbers. So the PPI, just as a reminder, is a key indicator for inflation. It's almost seen as the leading indicator, in fact, for CPI. And this is important because when the FOMC meetings got released last week, some of the notes, what was noted was the vast majority of participants believe the downside risks to employment have moderated, but the risks are more persistent with inflation now. So this is where we kind of want to turn more of attention. Expectation is for a 0.3% month-over-month rise for this Friday report that's going to come up. But apart from that, we're still kind of in the fourth innings now of earnings, Q4 earnings, or Q1 earnings in some cases. And the one I'm looking at in this case is going to be Broadcom. So Broadcom has its earnings coming out next week on Wednesday after the market close. This is a technology powerhouse that develops semiconductor chips, cloud infrastructure, software, and also wireless and broadband solutions. Again, it's part of the $1 trillion club at $1.6 trillion. Expectations are for revenue to come in at $19.1 billion and $2.02 on the EPS side of things. This is both a double-digit rise, so 19% on the EPS and 28%. But the big thing will be on AI that's going to drive expectations on this. What is the AI semiconductor revenue specifically looking at, and how are they going to be guiding around that? It'll look at demand acceleration on its tensor processing unit, so it specializes in what's called TPUs. So we'll see what the demand is on that. They're potentially eyeing about 40 billion is what they projected for this year, doubling that up. And then second of all is going to be the backlog, which is a lot of these AI companies have a big backlog. They're sitting at about 73 billion. So just to see what that is, what that means for the big roster of hyperscalers, which boasts OpenAI, Google, and Anthropic as part of it there. One of the sort of downsides to Broadcom is the gross margin compression. They did mention, management came ahead and said we've seen 100% basis points gross compression because of some pass-through costs. So we'll see if that's kind of more in line or if they've fared out better. But looking at the charts, the stock is squarely, I would say, categorize it in bearish territory right now. You can see from the charts over here, we have these highs sitting at about the 412 mark. It hit the low, dipping kind of just above the 290 level. But the technical picture for a bear market is 20% drop or lower from its previous highs. We're still in that 20% lower. But also, interestingly, it's made what I presented in the other case, which is an inverse head and shoulders, but in this case, it's just a regular head and shoulders, which is seen as a bearish reversal. So the key is to watch the break of this neckline. So if you can break below, kind of let's just put it at the 310 and close consecutively, we should see a move downwards. In this earnings print, you're either looking at a downside move towards the 290 level, possibly, if it gets punished, we're testing the 250. On the upside, we could probably touch and tag the 350, which is a key resistance for the last couple of weeks. Maybe even going to 380 if they really wow the street. So that's to look at.
Interesting stuff to watch on that. You got thirst.
Yeah, took a different approach from Hiren's high-tech analysis here. We're going a little differently here. We're going to look at Monster Beverage here. And so Monster Beverage is the definitive number 2 player. And if you can believe it, the $208 billion energy drink space globally here. So and they're number 2 globally and domestically. They're nipping at the heels of Red Bull. Monster, they've got a significant and a beneficial distribution partnership with Coca-Cola. That's been dating back over a decade now, back to 2015. They've been trying to broaden their appeal. real, kind of focusing on more natural. I'm going to put air quotes here on better for you drinks in there. And they've actually trying to kind of
healthy soda.
Right.
That's a new trend that I'm still trying to wrap my head around.
Right. So they're trying, right? They're trying to broaden their appeal, and they're even actually looking to target specific female consumers in that. So that's on the up. So we'll be listening for that in their earnings. But on the flip side of things, this is a space like this very low moat kind of a business here. They've got intense competition with deep-pocketed companies here. Keurig, Dr. Pepper, PepsiCo, they're investing heavily in this space. And you got to look out. I know Huron's done some analysis on this in the past. Celsius, they've made a meteoric rise. They're now up into the third spot. On the top of that, you've got greater concerns, right? There's the MAHA movement in the States, right? Around healthy living. So there is concerns about greater regulatory scrutiny around this as well. So it's one of those things. And then think about from a price, they're already above their analyst median pricing projection. They're well above fair market value. So the things that investors are going to need to analyze. But looking at the chart here, the stock price has been moving in very similar to TJX. We're up 43% over since August. So it's been making some higher highs and higher lows over the time. They've demonstrated positivity from an earnings perspective with gap ups in the last two. And even here, we've continued to the rise. Looking here, what kind of leading into earnings, there's a couple interesting formations that I want to point out. We've got a kind of an ascending triangle that we appear to have broken out of this morning. So we'll look to see if we get further confirmation as we get in there. But we've also got a double bottom, looking for those W's on the chart. W's can equal wins. So we'll see if that can happen. If earnings pushes us down out of that, because oftentimes there's retesting of these formations, the $75 range is certainly not out of question if we get pullbacks and weaker forecasts and expectations of earnings. So really going to be an interesting week ahead for Monster.
All right, two interesting names. Thanks for that. And before we wrap up the program, I just want to give a security reminder to our viewers. As tax season ramps up, scammers are impersonating banks, sending emails and texts that ask you to click a link to verify account details or complete tax forms, including the W-8 Ben requests. Red flags include urgency, pressure to act quickly, or unusual sender addresses. Remember, TD will never email or text you a link asking you to log in or submit tax forms. If you receive a suspicious message, don't click it, forward emails, or send screenshots of text to phishing@td.com. Well, that's our show for this week. We'll be back on Thursday, where our guest will be Chad Morganlander from Washington Crossing Advisors. Lots to talk about with Chad. We'd like to also thank our guests from the Wealth Contact Center for being in studio today. Keeps us on our toes. A round of applause for the boys, I think, right? They do all the hard work. I just get to ring the bell. As always, at home, investors should perform their own due diligence before engaging in trading. Thanks for watching.